Well, evening everyone. Thank you so much for joining us this evening. I'm sure you've already had a really packed conference so far. It looks like it's quite bustling out there. I was noting actually over at lunchtime, there were so many speeches already going on in the hall, and yet the Hyatt Hotel still looked rammed, as we say in Glasgow. I won't garble on for too long. I'm not the debt expert here. These people are. On my left, I've got Neil Alexander from Moneyline, Matthew Reid from the Children's Society, Justin Tomlinson, MP for Swindon North, and Mike O'Connor from Step Change. Each will speak for about 5 minutes, and then we'll open up to Q&A when we will then be joined by Mark Lionette. So Justin, thank you so much. I'm sure you're having a pretty busy conference with your constituency requirements and so forth. So over to you to tell us a little bit about your experiences of debt, and probably more specifically your constituents and how they're experiencing personal debt. Almost 9 million people in the UK are struggling with problem debt, so it's a serious problem, and one that I think probably affects so many people that we probably already know. And I remember my grandmother telling me way back in the day that I should spend half and save half, and I wish I'd listened to her. I didn't. So over to Justin. Thank you very much.
Well, thank you. And debt is a big issue. As a Member of Parliament, I represent Swindon, which is often described as an average town. We have an average in the sense that we have a bit of everything. And we see firsthand through our own casework where local residents have found themselves in situations of distress, that's job loss, bereavement, family breakups or ill health. And often through no fault of their own, very quickly become overwhelmed with debt issues. I mean, because we all must recognise we live in an increasingly complex world where we're bombarded with marketing messages, where we have most of our finances nowadays on direct debit standing orders. So you might lose your job on a Friday and think, right, I'm spending no money this weekend until I get a new job. You log on a Monday to your bank accounts and you realise, even though you've spent no money over the weekend, all your direct debits and standing orders have gone out of there. So, as a Member of Parliament who's very interested in consumer issues, I've spent a huge amount of time working cross-party with a number of MPs, looking at the best ways that we can empower consumers to help them. Because what we do know is 91% of people who get into debt, get into difficulty, have said that they wouldn't have done had they known better. Now, the challenge with that is hindsight's a wonderful thing. Not everything is always pre-planned, but I think there's a huge amount of truth in that. So, I've led a campaign in Parliament to deliver financial education as part of the national curriculum. You can probably hardly contain your excitement that we managed to successfully get this put into the national curriculum as of the 1st of September this year. This was a campaign that had the support of 300 cross-party MPs. It was the only campaign to be added to the national curriculum. There were 150 separate campaigns, all of them trying to get put into the national curriculum at a time that the then Secretary of State for Education was streamlining the national curriculum. So it was a major achievement to secure that. Now the whole purpose of that is to equip the next generation of consumers to be able to make informed and savvy decisions. Ideally, overnight we would provide financial education for every single one of us. But the state, it's difficult to round everybody up to give them training, but certainly within the schools environment we do have that ability, and I'm delighted that that will now take place. And as each generation passes through, that will make things far easier. We push for greater transparency, because if we are to empower consumers, they need to be in a position to make informed decisions. And for example, we saw with a lot of the payday lenders that they would by law have to advertise their interest rates, but even a Treasury Minister wouldn't be able to calculate, if I borrowed £100 for 2 days at 4,365% APR, how much that will actually cost. Everything must be shown in pure cash terms. If you say to somebody, I will lend you £20, it will cost you £3, everybody can make an informed decision whether that is right or wrong. We also need to make sure that hidden and excessive charges are also very clear and transparent. Crucially, we now need to make sure there is a pause. So if you are suddenly overwhelmed, there isn't an endless conveyor belt of rollover fees and excessive charges. So there is ability to seek help and then resolve the situation that you've got into. We crucially need to make sure that there is easy, signpost-free and debt-free debt advice, independent, so that again people can get genuine face-to-face help. I know through my casework that people will turn up with a carrier bag of unopened envelopes, and that they have become completely overwhelmed and they've only now, with the bailiffs turning up on the doors, seeking help. And we have a big problem in society that only 17% of people in debt will go and seek advice. There is a big stigma issue, partly because they want to sort of bury their heads, and also in some cases because they fear that actually seeking help will make matters worse and it will prevent them from getting further credit. And then crucially, we also must look at ways that we can rebuild people's opportunity. So if you have developed a very poor credit rating, and you have then no choice but to turn to some of these high-cost lenders because they are the only last resort option. But then in time that you rebalance your finances, you are paying back those lenders, that your credit rating should be repaired so that you once again get access to mainline credit. But finally, we as a society have to recognise that it's not a bad thing to save money. We all collectively want everything yesterday. As soon as the newest thing comes out, we all want to do it. But we also as a society have to understand the importance of this. The Prime Minister made a speech a couple of years ago where he said that we should encourage saving, and he was vilified in all of the national media, partly because the economy was struggling and there was a sudden fear that nobody was going to go and spend our way to economic growth. But the reality is we will all face shocks. I'm a financial geek. I have spreadsheets coming out of my ears on where all my money goes. Every Sunday, my wife is explaining why we really did need whatever that has arrived by courier, and nothing sneaks past me. But job losses happen. Hopefully, in my case, not next May. And so you cannot control all events, and therefore, as a society, we need to encourage having that buffer zone because that gives you the breathing space, the time to then make rational decisions. So I'm proud to have helped lead that financial education. It's a small part in what collectively we all need to do as a society to make sure that we protect particularly the most vulnerable consumers.
Thank you very much, Justin. And obviously, one of the main relationships that people will have will be with their bank or people who might provide some kind of form of lending or financial advice. And I think we'll ask Neil to perhaps speak a little bit around that actually, in his capacity for Royal Moneyline, and tell us a little bit about what his business does and how he, in his business, in some way, plugs a bit of a gap there.
Okay. Hello. You can tell by my accent that I'm not from the West Midlands. My wife's a Brummie, and she says to me every time I come south of the border, my wife always says to me, remember to speak slowly so that people can understand you. I have to tell you, this is as slow as I speak. Okay? So if you can't understand me at the moment, we're all in trouble for the next 5 minutes. You can translate. You're from the West Coast as well. Okay, my name's Neil Alexander. I work for a company called Moneyline, not-for-profit social business. We have 20 branches in the northwest of England, around places where there's lots of sort of championship football teams, Burnley, Blackburn, that type of thing, Accrington, Bury, South Wales. We lend about £10 million a year. We lend in a year what Payday will lend in about 2 days. And we lend it to a very specific customer. 2 out of every 3 customers that we lend money to are working age but not working. 3 in 4 of our loans go into the most disadvantaged 20% of households in the UK, and people are borrowing very small sums of money, very small sums. First loan £217, average loan about £400. We are officially a high-cost short-term credit company. We lend at an APR that is triple digit. We lend on a term that is under 52 weeks, so we meet the definition of high-cost short-term credit. We're the only company in the UK, as far as we know, who have an exemption from both the Payday cap and from any restrictions on Payday in terms of wealth warning because of the nature of our business, social business. We lend to cover cost, nothing more. That's what we try and do. We have a salary ratio of just under 4:1, top to bottom, 82 staff. And as I say, the profile of the customer is what may be of greatest interest in terms of who they are and a little bit about what they save. We lend to women. We lend to young women with children who rent their home. That's our customer. That is a typical customer. We are disproportionately seeing lone parents. We see about 45% of our customer base are lone parents. We see people in their 20s and 30s. That's by far and away our biggest group of people that we see. So it's young people who need small sums of money because well, we don't know each other. I don't know your financial history and circumstances. You don't know mine. So we're seeing people who, you know, for whom the cooker's gone, the pistons on the Peugeot 205, whatever it might be. You know, we lend for Christmas, we lend for all that kind of stuff. We make no judgment on what people borrow for. You know, so people have got a bit of bunce in their budget and they go on holiday or they go to a caravan park and rail. We make no judgment on that. We don't judge people on borrowing for televisions or any of that type of thing. If we did, they would soon tell us they didn't borrow for televisions. They'd tell us they borrowed for something else. So it's a very low income customer that we lend to. We lend to customers ignored and unwanted by anyone else. We offer a personal service. We offer flexibility. We see people face to face. They will fail credit checks. So we see people face to face, do an income and expenditure account inquiry with them. It takes about 45 minutes, and we make a judgment. We either decide we're going to lend you the money or we don't. Where we decline people, we try and refer them through a warm referral scheme to Step Change. Sometimes that works, sometimes that doesn't work. What is probably of more interest to you in terms of the brief that I was given is around the savings that we do. We offer a linked saving product. We are not licensed to take deposits, but we offer a linked saving product with Bank of Scotland. So if the loan payment is £5.54 a week, £5.54 a fortnight, and we think we can round it up for a customer, we round it up to a number that doesn't have 2 digits at the end, so £7, £8, that type of thing. And we sweep money into a saving account. This is the same customer I just mentioned, young women with children, lowest incomes, bottom 20% of income deciles, who everyone tells us don't save money, everyone tells us want more choices in terms of the saving product we have. Our saving product's not actually that good. 80% of new customers take out a saving account. We've opened over 20,000 saving accounts since we launched in 2002. We've saved, in that, £4.5 million has been set aside in saving accounts by our customer. Now they've withdrawn most of that money. They've withdrawn about 3.9 million of that money, but 4.5 million has been set aside. We open about 200 saving accounts a month, and we set aside about £100,000 a month into that saving account for customers. And people tell us in focus groups and in other places that £30 or £40 or £50 that they have at the end of their loan period makes a massive difference in their lives. People need choices. We offer people, I think, a kind of mildly coercive choice into taking savings. They trust our loan advisors, so people take out a saving account. That's how it works. So we mildly sort of push people into doing that sort of thing, because we think it's good for them. It prevents them from taking out another loan. We offer bank accounts, we offer advice. We'd like to offer some protection around insurance, because our customers are typically uninsured, but it's more likely to have, you know, house fires and break-ins, because the vast majority of our customers, as I say, are social renting. 84% or something are social renting. About 3% of our customers own their own home. So it's a very low income customer who borrow money, can't borrow from other places, are not going to be borrowing from Payday, certainly not borrowing from Payday anymore. That's moving as well from subprime to near prime. So we're seeing a very vulnerable customer who needs small sums of money to get by. Non-judgmental, social business, that's who we are.
Thank you very much, Neil. I mean, I think that we can all imagine what it must be like. You know, you're sitting at home and yet another letter comes through the post box, and that's a letter that's only adding to enormous stack that already exists. And as Justin mentioned, you know, this has a real human effect. You know, it causes stress. In some cases, it can make people feel suicidal. And I'd quite like Matthew now to talk to us a little bit about the human cost of debt and having debt in our society. So,
good, thank you. Well, first of all, thanks to our friends at Step Change for inviting us to be involved in this panel tonight. At the Children's Society, we try and support children to have great stories in their lives, and that necessarily takes us into challenging situations where children are not having great stories, where they're not able to thrive and not able to flourish. And the research we've been doing with children living in poverty had showed up that problem debt was a significant issue in those households. So what we thought we would do, along with Step Change with our friends there, is to understand what impact is that problem debt having on children in those households. It's very well documented the impact it has on adults. It's less well documented the impact it has on children. Now, to our surprise, despite our anecdotal information we had from our own families we work with, the impact the problem debt is having on children in this country is quite substantial. 2.5 million children living in situations where they are in families that are struggling with problem debt, by which we're defining that as a level of debt which is not repayable. through normal repayment mechanisms. Some of that is obviously to loan companies, some is to local authorities, and some is to utility companies. Now what we did is we surveyed children to understand what was actually going on in their lives, and the results were actually quite shocking. It showed, perhaps unsurprisingly, but it documented carefully the level of stress that families living with problem debt are experiencing and how that stress is being transmitted to children. It showed that children living in problem debt households are often far more susceptible to being bullied at school. It showed how children living in problem debt were far more susceptible to social isolation. And it showed that children had much lower well-being and the early signs or the more developed signs of mental ill health. So we've seen these families being stuck in a debt trap, and what we're trying to do as a charity is see how we can protect families from getting stuck in this debt trap and support families living in that debt trap to be able to get out of it. So on a practical basis, we work with a number of families throughout the country who link in with some of our children's centres or some of our other projects. What happens in our children's centres is that people often come to talk about something else, such as can they come to a stay and play session or something that's easier to access. But our workers quite quickly get alongside and find out what's really going on in their lives, and conversations move on to the level of indebtedness in the house fairly quickly. So rather than just doing the research, what we've started to do is to find ways with Step Change and others where we can actually offer tangible debt advice to those families and signpost families to the correct sources of getting proper advice, etc. That's also led us to start to work with the Archbishop of Canterbury's task force on responsible credit with Sir Hector Sands' group. That we think is going to be an important way of trying to increase availability of credit for families who need it on appropriate terms. Part of the question that was framed for tonight is, well, what can be done about this and what would we like to happen? If you've been through the secure zone this morning, you might have been confronted by one of our teddy bears who are outside the secure zone this morning. We've done some research with YouGov that's shown some quite alarming statistics again about the impact that payday loan adverts are having on children. Anyone who's ever seen any of these adverts, they won't have escaped your attention. They're not exactly aimed at people of my age or demographic background. They're aimed at children. The use of characters, fuzzy toys, etc., cuddly toys is designed to try and first of all increase the strength of pester power, but secondly increases the general pressure in families to want to take out loans at very high interest rates. So one of the first things we're trying to do is get a greater sense of sort of regulation around how the payday loan adverts work. We think there's a very strong case for saying that those adverts shouldn't be shown before the watershed. We don't allow adverts for other things we see as being antisocial or children's lives to be shown before the watershed. Why should we allow payday loan adverts to happen there? Not just to reduce the pester power side, but also because these adverts, through our research shows, are one of the main sources that children have at the moment of financial education. And which again, and it can't be a great thing for children to be educated in a way of how to manage their money through payday loan adverts. This might not sound very likely, but the research again shows that at the age of 7, most children could name quite a number of payday loan companies, and that's not a great way for our society to be heading, we would say. So first of all, we think there should be a ban around that and much greater regulation around how payday loans operate. But secondly, and as constructively we think, there should be some greater support for children to be able to start saving whilst they're still at school. In fact, we think that children should be able to start savings clubs by the time they're aged 7. And this sort of key age, this formative time of children's lives. So again, with the Archbishop as a task group and with others, we're working on a school saving plan at the moment. We've got some information about that if you'd like to have some later. We're going to be launching this report later on this autumn. It makes the case for what's really important about savings clubs in schools. First of all, that it actually happens. There's a chance for children to actually pragmatically start to save some money. Secondly, that it's linked in with other parts of the curriculum. So the great work that Justin's been doing on the national curriculum, having a pragmatic way of saving in school actually grounds that education to make it a real thing. But thirdly, we know that needs to be rooted in the wider community. So finding a way in which we can link up with other organisations and other aspects of children's lives. It gives us like a Trojan horse into families also about responsible saving and responsible credit. So changing children's stories, we think at the moment we're in a situation where problem debt is driving down not just the life quality of children now, but it's having a huge detrimental impact on their futures. That's rubbish for them, and it's rubbish for our society as a whole, and that's what we're trying to find a way of trying to lift the burden of problem debt on families and children today.
Thank you very much, Matthew. And I think we all agree in this room that this is a problem for wider society and for policy makers. And with that in mind, I think I'll throw over to Mike, who hopefully will have all the solutions.
Yes.
Thank you. Step Change Debt Charity is the UK's largest debt advice charity. We have about 1,200 staff dealing with more than 1,000 people every day who come through on our phone and online. So I want to talk about what we see, why it's happening, what I think we can do about it. Start with some good news, is the people owe less money than they used to. The amount of unsecured debt people have, that's excluding mortgage, has fallen from about £25,000 per head in 2008 to about £16,000 today. However, the bad news is the makeup of that debt. The makeup of people's debts now is much more likely to be not some foolish purchase of a car or a flash TV. It's energy costs, it's council tax, it's transport. The average energy bill debt we see is £1,000. Now that's a debt that just keeps adding up, because unless you turn the gas and electricity off, which sadly too many people do, self-disconnect, that bill just keeps going up. So the nut is smaller, but it's harder to crack. However, the issue is not just those people, brave people very often, who come to us and ask for help. It's there are millions of families out there who are getting by, just about coping, keeping their head above water. But it only takes a small income shock, such as an interest rate rise, and many of them will be in trouble. And the trouble it leads to is something which is not just their individual, but their family too, as we've just heard. Being in debt, problem debt, doubles your chance of being mentally ill, doubles it. 7% of the parents we see split up as a result of debt. It's a brake on people's capacity to work, to get back into work. It's a brake on aspiration and potential. So the second bit of good news, which is not really news anymore, is the economy is growing. We now have a sustained recovery. But we need to make sure that all our citizens take part in that, not just on the grounds of fairness, but also on the grounds of more of our citizens take part in the economic activity, the stronger and more sustainable our recovery will be. So the reason families are struggling is pretty clear. According to the CSJ report, maxed out, real incomes have fallen to 2003 levels, while the average cost of living has risen by 25% in the past 5 years. And as a result, the Bank of England have told us that savers have been withdrawing money from their accounts at the fastest rate for 40 years. Last year, £23 billion was removed from long-term savings. That's equivalent to £900 for every household in the country. And I know interest rates don't really encourage you to save, but I think that level of withdrawal shows that people are taking money out, probably for everyday essentials. So our UK households save less than almost any other country in the EU. And our report, Life on the Edge, and other research from other charities show that millions of people don't have enough savings in place. They lost their income to last the month. So what can we do? Well, one of the first things we can do is we need to do something about savings. Around 20 million people don't have a savings buffer to get them through the 3-month fall in income. We spend a lot of money as a nation on supporting saving, but it's not always for the right people. I can take out an ISA, £15,000 every year, and I don't pay tax on the profits. I can invest £40,000 every year in my pension fund, and I get tax relief that on the highest rate. So I think that we're quite generous with incentivizing saving. What we're not doing is helping people on low incomes to save. And I'm very glad the government has bitten the bullet on auto-enrollment for pensions. I think they should extend that principle to short-term savings. And one of the reasons they need to do that is we have about 160,000 people repaying their debts through us, typically around £250 a month. And they're managing that. But then something goes wrong, the washing machine breaks down, and they've got to replace it. Kids need clean clothes. And what you see is they break their savings plan. So what I'm trying to encourage accreditors, to everyone to accept that even though you're paying back your debt, you should be allowed to encourage to save money, as we've heard as well, so that you don't break that habit. Secondly, we need to do something about the insolvency regime. For all the people who are paying their debts back, many of the people who come to us, they just can't repay their debts. And we've got to find a way of helping forgive that debt, consistent with being fair to the creditors and to the rest of us who pick up that debt. We have a system such as debt relief orders, but they're very expensive to set up and administer, and the costs of those are largely falling on charities like us and Money Advice Trust and Citizens Advice. So we need to make that system easier. Thirdly, I only joined this organisation 9 months ago, and it came as a shock to me to find out who were the worst agencies for pursuing people who are in debt. Who was most likely to take you to court over a debt? And it's not the rapacious banks or the evil credit card companies, it's local authorities, it's HMRC, it's our public bodies who are most likely to take you to court. And there are pressures upon them because it's taxpayers' money and we all want people to get our council tax repaid, etc. But the fact that the banks have got higher standards than the state is something I think we should be worried about and do something about. Fourthly, as been said earlier, we need to make sure that debt advice agencies such as Money Advice Trust, Christians Against Poverty, Step Change Debt Charity are resourced to provide help. Only 17% of the people who need help get help, and that's partly because they're not aware that they can get help. And more people than come to us go to commercial companies and actually pay fees to get the advice which they get for free from us. So we need the organisation to be properly funded, and for our part we need to collaborate better together, so we offer a joined up service. The last point is we need to find some way of giving people a reward for doing the right thing and facing up to their debts. All too often people in debt don't open that envelope, they bury their head in the sand, they hope it'll go away. Well, in Scotland there's a system whereby if you enter into a debt repayment plan, one that you can afford, interest and charges are cancelled. And that's the incentive. Come forward, do the right thing, then we'll get rid of interest and charges. In England and Wales there is no such scheme, although we can persuade banks to do it sometimes. We can't go out there and offer to people, you come forward and you get this benefit. So there are things we can do, and that change in British law wouldn't take primary legislation. There's already primary legislation which would enable it to be put in force by regulation. So there are things we can do, and as has been said, debt is a natural part of life. It's a natural result of a free market economy. Many of us live happily with debt, but problem debt is a social and economic and political problem. And in the same way that we've had to do tough things to tackle our national debt in this country, we need to tackle personal debt as well, both for fairness and in terms of driving the economy forward.